Did you know that 99% of retail investors lose money in the stock market? It's not because the stock market is a scam, it's because they're making the same predictable mistakes over and over. They buy high on emotion, sell low out of fear, and chase the next hot stock tip without doing any research. They think they can get rich quick, but in reality, they're just gambling their money away. In this video, I'm going to show you the most common mistakes people make in the stock market, and more importantly, how you can avoid them to become part of the 1% that actually makes money. We're diving deep into the psychology of investing, proven strategies for success, and I'll even share some of my own personal experiences to help you learn from my mistakes. Whether you're just starting out or you've been investing for years, this video is for you. So buckle up, hit that subscribe button, and let's get started. One of the biggest mistakes investors make is letting their emotions dictate their decisions. Think about it, when the stock market is booming, everyone's feeling optimistic. You see your friends and family bragging about their gains, and suddenly, you're hit with FOMO, the fear of missing out. So, you jump in head first, buying at the top of the market without thinking twice. But then, what happens when the market inevitably takes a dip? Fear sets in. You watch your portfolio shrink before your eyes, and you start to panic. You sell everything at a loss, locking in those losses, just as the market starts to recover. Sound familiar? It's a classic cycle of emotional investing, and it's a surefire way to lose money in the stock market. Let me give you a real-world example. Remember the 2021 crypto boom? Everyone and their grandma was buying Bitcoin, Ethereum, Dogecoin, you name it. People were getting caught up in the hype, throwing their life savings into these digital assets without truly understanding what they were investing in. They were driven purely by emotion, not logic. And what happened? The bubble burst. Bitcoin, which peaked at nearly $69,000 in November 2021, crashed down to around $16,000 just a year later. Countless people who bought at the peak, driven by fear of missing out, saw their investments evaporate practically overnight. This is why emotional investing is so dangerous. It clouds your judgment and leads to impulsive decisions that can cost you dearly. The key is to remove emotion from the equation as much as possible. Develop a sound investment strategy based on research and logic and stick to it, even when the market gets turbulent. Have you ever heard someone say something like, "This stock is the next Amazon," or "This is a guaranteed 10 times return," without backing it up with any real research? Yeah, that's a major red flag. Blindly following the herd and chasing the next hot stock tip is a recipe for disaster in the stock market. Remember GameStop in 2021? A group of Reddit users on the subreddit r/Wall Street Bets managed to create a massive short squeeze, sending the stock price of the struggling video game retailer soaring. It became a social media frenzy, with everyone from seasoned investors to college students jumping on board, hoping to make a quick buck. But here's the thing. Many of those who piled into GameStop at its peak, driven by hype and herd mentality, ended up losing a significant amount of money. The stock price was completely detached from the company's actual fundamentals, and those who didn't cash out at the right time were left holding the bag when the bubble inevitably burst. This is why doing your research is absolutely crucial before investing in any stock. Don't just rely on what you see on social media or hear from your friends at the water cooler. Dig deep into a company's financials, understand their business model, analyze their revenue streams, and assess their long-term growth potential. Remember, investing is not a get-rich-quick scheme. It's about putting your money to work in companies you believe in for the long haul. So, take your time, do your due diligence, and don't be afraid to be different from the herd. Sometimes the best investments are the ones that nobody is talking about, yet. Let's talk about risk management, one of the most overlooked yet critical aspects of investing. It's not the most exciting topic, but trust me, understanding and implementing proper risk management strategies can be the difference between building long-term wealth and blowing up your account. One of the biggest mistakes beginners make is putting all their eggs in one basket, so to speak. They get excited about a particular stock or industry and go all in, investing their entire portfolio in just one or two companies. While this can lead to significant gains if those companies perform well, it also exposes you to massive risk if things go south. Imagine you had put all your money into Enron back in the early 2000s. Enron, an energy giant at the time, was considered a Wall Street darling. People were impressed by its rapid growth and stellar earnings reports. However, beneath the surface, Enron was engaging in massive accounting fraud, hiding billions of dollars in debt. When the truth came out, Enron's stock price plummeted, wiping out billions of dollars in shareholder value, including the retirement savings of many employees. This is a prime example of why diversification is so crucial. By spreading your investments across different asset classes, industries, and companies, you're essentially mitigating risk. if one investment underperforms, it won't have a devastating impact on your entire portfolio. Think of it like a safety net for your investments. Another important aspect of risk management is determining your risk tolerance. How much volatility are you comfortable with? Are you more risk-averse, preferring slow and steady growth? Or are you willing to stomach bigger swings in pursuit of higher returns? Understanding your risk tolerance will help you make more informed investment decisions and prevent you from making rash choices when the market gets bumpy. Remember, investing is a marathon, not a sprint. By prioritizing risk management, you're setting yourself up for sustainable, long-term success. Why overtrading can kill your returns. Let's talk about overtrading, a habit that can seriously sabotage your investment returns. It's easy to get caught up in the excitement of the market, constantly buying and selling, trying to time every dip and ride every wave. But in reality, overtrading often leads to more harm than good. You see, every time you trade, you incur transaction costs. These costs might seem small individually, but they can add up quickly, eating into your profits and even leading to losses. Think about it. If you're constantly buying and selling, you're essentially giving a portion of your returns back to the brokerage firm in the form of fees. Moreover, overtrading can lead to impulsive decision-making. Instead of sticking to your carefully crafted investment plan, you might find yourself making rash trades based on emotion or short-term market fluctuations. This can lead to buying high and selling low, the exact opposite of what you want to do. Remember, investing is a game of patience and discipline. Legendary investor Warren Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." And he's absolutely right. Instead of trying to time the market, focus on identifying undervalued companies with solid fundamentals and hold on to them for the long term. Allow your investments to compound over time, benefiting from the power of compounding returns. Think of it like planting a tree. You wouldn't dig it up every few weeks to see if it's growing, right? You plant it, nurture it, and let it grow organically over time. Investing is similar. Find good companies, invest in them, and give them time to flourish. Don't get distracted by the noise of the market or feel the need to constantly tinker with your portfolio. Remember, true wealth is built gradually, not overnight. So there you have it, the 4 most common mistakes people make in the stock market. The good news is that by understanding these pitfalls, you're already one step ahead of the game. Remember, investing is a journey, not a destination. There will be ups and downs along the way, but by staying informed, being patient, and avoiding these common mistakes, you'll be well on your way to achieving your financial goals. If you found this video helpful, be sure to give it a thumbs up and subscribe to the channel for more videos on personal finance, investing, and building wealth. And let me know in the comments down below, what's the biggest mistake you've made in your investing journey so far? I read every single comment and I'm always here to help. Until next time, happy investing.